Hey, what's up, guys? It's Online Money 24/7, and today we're going to be talking about how to invest your first $1,000 in the stock market. So first off, I wanted to say congratulations to all of you who have actually managed to save up $1,000 that you don't have any debt, and you're ready to go ahead and invest that into the stock market. So today we're going to be going through how to actually go about doing that and a smart way to kind of break down your money so that you're diversified, but also in the best position to make some returns on the money that you saved up. So, where are we going to be putting this money? Where to put it? First off, you're going to take $400, 40%, and put that into a growth stock. Now, I am going to list some examples of growth stocks that I am familiar with. However, these are just within my circle of competence, and that is something to keep in mind when investing in general, really, is to don't invest in a company you have no idea what they actually do. That's why I'm explaining this before I actually show you the companies that I'm going to be using as examples today. But always invest in companies that you have a circle of competence around and understand how they actually make their money, how they operate, and what they're up to as well. Like if they're going to do any new things and stuff like that. Just make sure they're companies that you trust and full-fledged believe in. Because you're putting your money into the company, essentially. You are buying a small piece of that company. That's how investing works. So today we're going to be talking about PayPal, Facebook, Shopify, Square, Inc., and Netflix. And these are just examples. I'm not saying to put all $400 into these stocks specifically. These are just stocks that I'm invested in some of these companies, and I am just familiar with them. And they are pretty big companies at this point. Most of you watching this video probably already know who these companies are. Of course, you probably know Facebook and Netflix. The other ones are a little bit more obscure, I guess you could say. But if you're in the tech space, you definitely know what they are. Of course, PayPal as well. But these are companies that are growth oriented. And that's why I selected all these for this slide. 40% is going to go into a growth stock. So pick one stock. It doesn't have to be any of these, of course, like I said before. Pick a growth stock, and that essentially means that it is like a mid-cap. So it's not a huge company. It hasn't been around for 60 million bajillion years, but it also isn't a penny stock. It's it's in the middle there. So it has some strength, but it also is steadily growing. So for example, PayPal has grown around, I think it's about 100% this year, maybe 60% this year. I'm not exactly sure 100% on the numbers, but it's grown a good percent this year. Whereas, for example, some other companies I'm going to be talking about later in this video, they've only grown maybe 15%, but they're more secure. So it's kind of a trade-off. So, find a growth stock that you fully believe in. It might be Facebook, for example. You put $400, 40% of the $1,000, or however much you have. $1,000 is just the what we're using for the examples in this video. If you have $1,000 to invest, it would be $400 is 40% of that. And you're going to take that. You could buy about 2 shares of Facebook right now if you wanted to. I'm not saying to do that, but that's an example of a growth stock that you could invest in with your 40% that is going there. Okay, moving along. Next, $200. The next $200 is 20% into a second growth stock. So you're going to pick that second favorite company that you have, one that you see a future in, and put a $200 investment into that. So, for example, if we were going to, and it needs to be a different company as well. So the first one is 40% into, say, for example, Facebook. The next 20% needs to be in a different company. So for today, we could use PayPal as an example. So the next 20%, or $200 in this case, would be in PayPal. And you could buy a few shares. You could buy maybe 3 or maybe 4. I think about 3 to 4 shares in PayPal right now with $200. So that'd be your next 20%. Moving along, next is the next $200. The next 20% is going to go into a blue chip stock. So as I said before, these are more, the majority of this portfolio is growth oriented, because when you don't have a ton of money, you can't really put it all into blue chip stocks because, I mean, sure, it's super duper safe, but you're hardly going to make any return at all, especially with only $1,000. So it would make more sense to put it into a growth company that you see a future in, and they're also very safe companies. They're not penny stocks. They're not going to just drop out of face of earth. You know, they are established companies, these mid cap companies. But it's smarter to put, when you don't have a ton of money, to put more into a growth stock, especially if you're young. You know, you have the extra money, you have the time to recover if anything were to happen with a company. But these are companies that are pretty sizably established. A Netflix, a Facebook, I mean, they're pretty established companies, and they are more growth-oriented. So it's smart when you don't have a lot of money to put into the stock market to put it into more growth-oriented stocks. That's just how I operate. So moving along, the next 20% into a blue chip stock. You want to have a good backbone because at the end of the day, you don't want to put all of your eggs into the growth stocks, because then you're not really diversifying enough to where, you know, if anything happens, you don't have a strong backbone to your portfolio to keep you secure and any kind of changes in the marketplace. So that's why I recommend to put next $200, 20% into a blue chip stock. So the examples today, Johnson & Johnson, a McDonald's, a Coke, or a Procter & Gamble. Those are companies that have been around for like 100 years. They pay dividends as well, which I will have probably a dividend video in the future going more in depth about what that is. But essentially, just for today, it's a piece of the company that they pay you back for owning a share. So if I were to own a share of Johnson & Johnson, they would pay me a small percent of the total amount of money that I have invested quarterly. They pay quarterly. Other companies pay different parts of the year. Most of these big companies pay quarterly, and that Johnson & Johnson's may be in October. It's not they're not all on the same exact day. They have their own dividend days, but they pay me back a small percent of the amount that I've invested in their company. So, you know, that's what you're also going to get with these blue chip big stocks, are going to be a little bit of dividend payback, which is nice to just reinvest into your portfolio. So you're going to pick one of these. It doesn't have to be these specifically. You know, it could also be an Apple. Apple's a pretty big company as well. Hasn't been around as long as Johnson & Johnson, McDonald's, Coke, or Procter & Gamble. That's why I would say these are the bigger, more secure blue chip stocks, for example. There are a lot of others, of course, but these are some of the really biggest ones that have been around for a long time. So you're going to pick a blue chip stock, a big, you know, been around for forever, as a nice backbone to your portfolio, and that's going to be 20%. You're going to pick one. So with these companies, they're generally, some are a little bit more expensive. So like a McDonald's is a little bit, you might only really be able to get one share with $200. Same with Johnson & Johnson, you could only probably get one share. But with Coke, I think you can get around maybe 3 to 4 shares, actually, with $200. So, and then that's going to be in one of those companies. Like I said, it doesn't have to be one of these specifically that I chose, but a blue chip stock. Next $200 is going to also go into a second blue chip stock. So you want to diversify a little bit. You don't want to put it all into just 2 companies. That's why we have 4 different companies that you're investing into, to diversify a little bit, just in case one has a rainy day and it messes up things a little bit, dips down. Well, your rest of your companies are hopefully going up, so that balances things out. That's important to diversify a little bit. You don't want to over-diversify and have 20 million stocks. You also don't want to under-diversify and only have 1 or 2. You know, you want to have it a healthy medium. So the second blue chip stock, so for example, I could pick McDonald's and Johnson & Johnson. Those could be my 2 blue chip stocks that I go into. And then you're also wondering, well, where's the last $200 go? Because that's only $800. Well, that is your sideline money. So, to explain, you save this for a negative 5% day on one of your growth stocks. Because generally those blue chip stocks aren't going to really move 5% in a day. They move really slowly, up or down. So this would be on a growth stock that you see maybe moves down 5%, and that's a discount right there. And holding this extra bit of money, 20% or $200 if you have 1,000, would allow you to capitalize on a discount. So if a stock goes down 5%, that's a discount right there. You could buy a stock for cheaper than it would normally be. And it's not like the stock has lost any inherent value. It may just be that the stock market, the S&P, or I'm sorry, the NASDAQ, went down, or the Dow, or whatever, the whole stock market in general had a trend down that day, and your stock went down 5%. So it may not even be that the company is doing anything different. The market fluctuates. And so you could pick up your one of your stocks on a nice discount, get some more shares if you're going to, be constantly investing, which I'm going to be getting into in the next slide. But yeah, save that little bit of money so it's ready on the sideline to strike. You want to be able to capitalize on any kind of discounts that become available to you. Because if you don't have that extra money, it takes time to be able to transfer money from your bank account to your investment account, and then by then you would have lost the opportunity. So you want to keep it in your investment account on the side as cash to be able to strike. Moving along, things to keep in mind with this. You need to keep adding money to your investment portfolio. I cannot stress this enough. You need to keep adding money to your investment portfolio. It's great. You're starting with $1,000. It's an awesome jump start. But you need to keep adding money, because if you don't, your investments won't grow a lot. Like, the biggest part of investing is to keep putting money into the account. It's basically a glorified savings account that pays you more money with as you put more. You put more money in, and you're going to make more money off your money because you have more money. I know it's kind of a tongue twister there, but you want to keep adding to your investment portfolio. It's very important. Maybe $100 a month. It doesn't even have to be a lot of money. You start with 1,000, you just put in an extra 100 each month. That adds up a lot over the course of about a year, 2 years. That's a lot of extra money that you're putting into your investment portfolio. That's very important to do. So you're starting with 1,000, but you want to keep adding to it. And second, you want to check on those stocks daily for any news around your companies. And this is, say they have a new product coming out. Well, it might be good to know that so that you might want to buy some more shares. Or if there's a nice spike based on an earnings report, for example, PayPal, probably a better example than Facebook. Facebook's a little bit more steady. Facebook's honestly on the edge of a blue chip growth type stock, so PayPal's a little bit more growth stock. So say, for example, they had some kind of news around their company, they shot up a ton. You might want to sell and just make a little bit of money on that huge spike, and then buy back when the price goes back down. So it's important to keep updated on news around companies, especially maybe there's some bad news going on. You might want to know that about your company. Maybe you want to get out of that company. I'm not saying, make hasty decisions based on news. A lot of these news articles. Oh, and by the way, the orange A there is Seeking Alpha. It's an app that you can download that gives you stock news, and you can punch in different companies that you own, and it's really, really solid. But going back to what I was saying, you don't want to be hasty with any buy-sell decisions. You want to think it through, because there might be bad news articles. Not all those news articles are exactly true. A lot of them are biased. Even they may not be trying to sell you on buying a stock in the company, but at the same time, they may be a little bit biased. Someone might be having a bad day, and they write this article talking about how crappy Facebook is and how horrible of a company it is, when in reality, it really isn't. And so they may just be spewing a bunch of garbage. So don't take any news as fact. I mean, that's something you should probably already know. But yeah, just don't make any hasty decisions based on news articles that you read on your stocks. Think it through and analyze in your eyes, based on facts that you can find, on decisions that you should make. Another news outlet, Yahoo Finance as well, is a great one that has a lot of articles on there. So yeah, Seeking Alpha is the orange A there, and Yahoo Finance is also another great option for finding information on your stocks. But take some of the news, a lot of the news actually, with a grain of salt. There may be one article out of 100 that's actually worthwhile. But you gotta do that research if you're gonna be invested in the stock market. You gotta keep up to date on your companies that you're invested in, because you're putting your finances in the hands. You're investing your money into a company, and you want to make sure that that company is moving in the direction that you want it to do, which is up. You want to make some more money, of course. And lastly, you're going to actually need a brokerage to be able to buy these stocks, which I use Robinhood because it's a free stock trading app, and there's no commissions on trades. So a lot of other things like E-Trade or Vanguard, you got to pay $10 every time you want to make a trade on your stock. Whereas with Robinhood, and it is protected by the FDIC as well, if you want to do your own research, which the FDIC is basically insurance for a bank or an investment brokerage account. You're protected up to $500,000, so it's safe. If you're wondering, it's this trading app, it's very safe and secure. It is backed by the FDIC insurance protection. So it's a free stock trading app, Robinhood. No commissions on trades. It's great. That's what I use. They also have a percentage calculator in there too, so you can see how much of a percentage a certain stock holds of your total portfolio value. They also have the articles in there. Like I said, the Yahoo Finance and the Seeking Alpha. Those are linked on the stock pages on Robinhood. So it's a very nice app. I really like the design. And if you were to sign up as well for Robinhood, I have an affiliate link below, which you can get a free stock, and that could get you started. It'd be maybe around like $5. If you click the link below, that'll get you signed up for Robinhood. That's what I use. I highly recommend it. So yeah, guys, if you enjoyed this video, be sure to leave a like, subscribe to the channel for more investing type videos. I'm going to be doing a whole lot of those in the future. Leave a comment if you have any questions as well, and I'll see you in the next one. Peace out.